For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade. I'm just here to ask the questions, but of course, the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group, and Randy has the week off this week. So Jake, how are you doing?
I'm doing great, Jeff. Thank you for asking.
Certainly welcome, my friend. Hope everybody listening to the program's having a great Saturday morning. Before you know it here, Jake, Thanksgiving is going to be upon us, and I can't wait for that. The holiday season is near. But we've got a lot to talk about on the show today. I know that you were not with us last week, Jake. You were very busy with the new president coming into office. You were making some plans and making trades and just sort of preparing people for what's to come. So you and I are due to have a conversation about how the Trump 2.0 presidency is going to affect our listeners in their journey towards a confident retirement. So first off, let's talk about the Dow a little bit. The Dow has really responded well to Trump's presidency.
Yeah, I think, the Dow getting above 44,000, a lot of that's due to the components in the Dow. And, honestly, as they rework those components over time, there's 30 different stocks in the Dow. That's why they call it the Dow 30 or the Dow 30 Industrial Average. But they're now replacing Intel with NVIDIA. And it's starting to look a lot more like the NASDAQ than it is the Dow. However, the Dow is also very heavy in bank stocks and financials. And so when Trump was announced that he won, those bank stocks immediately assumed that they were going to have deregulation. And regulation is the ultimate stopper of business, especially when it comes to banks. And so they're now looking at deregulating these banks, lowering reserve requirements, and if they simply are able to put more money to work, loaning it out to people, then that's going to help their profit margins, and everybody makes more money, everybody's happy, and therefore the Dow's happy.
Would you anticipate that the stock market is going to continue to react like this, or is this just a temporary bump?
Jeff, I've kind of been asking myself that same question. I do think that we're probably going to see it go higher through the end of the year here, and even into and up to the inauguration. It would not surprise me to see once Trump actually gets inaugurated to see it pull back a little bit and regather itself, especially if it keeps running the way it has been. I do think that there's plenty more to come on the other side, but we are pulling forward some of the things that Trump is going to do, and we're celebrating it today, which is great. But if there's any changes to that the market doesn't like, those are not priced in yet, even though a lot of the good news is being priced in right now. Like tariffs, for example, there's a lot of apprehension around tariffs. But I think that a lot of the deregulation, the pro-freedom of speech things we'll talk about in a minute, all that kind of stuff is very pro-market. And, Trump has done a lot already since his being reelected, even though he's not in yet. I think he learned his lesson from the first time, where it took him a year and a half, some would say 2 years even, to get his cabinet straightened out and his administration straightened out. And I think he wants to waste no time this time, and so he's already appointed a lot of these people in the last few days.
Right, and as opposed to the last time, now he's experienced it doing this, so I think it's going to be a little bit different story. We should get things rolling a little bit quicker. Let's talk about Bitcoin. Boy, Bitcoin has really been on a rip lately as well.
Yeah, and so Bitcoin, it was pretty widely expected that if Trump won, Bitcoin would go up quite a bit. So J.D. Vance has ties to Bitcoin. One of his business partners, Peter Thiel, who's a Republican mega donor, also has a lot of ties to Bitcoin. Trump, was the Bitcoin keynote speaker at the Bitcoin conference earlier this year, and he said that, if I'm elected, I'm going to be the Bitcoin president, and he said something to the effect, it's going to be just terrific, folks. he gave like a I think it was an hour and a half speech at the Bitcoin conference. And so everybody's expecting, again, more deregulation of Bitcoin, of banks, all this kind of thing. But that deregulation or promise to not regulate it looking forward and allow Bitcoin to exist outside of the current frameworks of securities or foreign exchange and that kind of thing, I think that's partially what's making it run. But a lot of it is it has been stuck in a trading pattern for almost a year now, where it was just kind of bound up. And it broke out of that after the election, and man, it went really, really far, really fast. So where it ends up, I don't know. But if it keeps going, it might be time to take some profits before too long if you're invested.
Jake, in the past year or two, we've talked about Bitcoin in the past, and before this, we've had some skepticism about it. Do you think that Trump's encouragement about Bitcoin maybe will cause us to re-examine it a little bit as an investment here in the near future? I think that Bitcoin is still... A lot of people, certainly listening to the show, I'm sure, feel like Bitcoin is very nebulous and there's nothing to reach out and touch. It's not tangible. I do think Bitcoin will always be around, and the scarcity of Bitcoin, the inherent scarcity of it, is really what gives it its luster, if you will. And that's never going to change. There's always going to be less Bitcoin looking forward at this point than there is today, through people losing it. And we talked about this a few weeks ago, but losing their passwords burns Bitcoin. You can't get it back. Right.
And we're almost out of Bitcoin to mine. I think there's like 1.2 million coins left to mine out of the 21 million that will ever be mined. This decreasing availability of it should, in theory, keep prices going up. But it just depends on, if the market at some point gets bored and says, you know what, I know we said this has value, but let's move on to something else. And I think that's the wild card that nobody can really predict.
We're talking with Jake Floyd of Floyd Financial Group. Our program is called Show Me the Money. We're talking a little bit about the Trump presidency 2.0. Our telephone number, 417-889-7233. Write it down because you're going to need it. Let's continue our conversation here. I understand, Jake, that we have a new border czar, or at least we've appointed one.
Yeah, so Mr. Tom Homan, who was the former head of ICE and immigration, he recently got named the new border czar. So he's taking Kamala's position there. Anybody who knows Tom Homan or has seen any of the things that he has done knows that he's a junkyard dog. He'll definitely get the job done, whether people want him to or not. He's going to be ready to do it. He was one of the ones advocating for zero tolerance during the whole Dreamer thing and all that. So I think he's a good pick if you actually want to get the illegal immigrants deported. And, he's not afraid to stand up to anybody, no matter who it is, including when Congress was grilling him about a bunch of garbage that really wasn't his fault. They kept telling him to be quiet, and he wouldn't be quiet. He's full gas all the time, and I think that's the kind of guy we're going to need to clean this mess up.
So the border czar is going to deport all the illegals. If we do that, being that a lot of agricultural workers in places such as Central California are illegal workers, how will that affect opportunities for American workers, do you think?
Yeah, I think there will be some jobs freed up for people. There are some concerns about it, right? If we just simply eliminate a bunch of workers, and then we have people then looking for jobs again, people that were looking for jobs in 2021, 2022, 2023 may have found it difficult to find a job. We'll have the opposite problem now, where we'll have people, employers looking for people and can't find it, which should help wages overall because they'll have to pay more to find people. So I do think that it will be somewhat of a shock, maybe more than people are expecting, especially if they're very effective at it and we just simply deport, 10 million people over the next 6 months to a year or something like that. That'll be quite the achievement if that happens. But if it does, we will definitely feel that. But, we can't have people just coming over here illegally. People's first action as a United States resident can't be to break all the laws. To quote another Trumpism, either we're a nation of laws or we're not. And if people do not follow the law, then we do not have law and order. And the first step to getting law and order back is to hold people accountable for crimes.
Jake, I understand that President-elect Trump has an opinion about the First Amendment, and he wants to protect that. Can you explain more about that?
Yeah, so probably about a week ago or so, he put out a video in the middle of the night of him detailing exactly how he's going to go about protecting the First Amendment, how he's going to defend the First Amendment to people who have already violated the First Amendment. A lot of these big tech companies that have been proven to be censoring speech, especially leaning one political direction or the other. He wants to go about prosecuting those people. He wants to make sure that it's illegal for big tech companies to get involved in politics looking forward. He's going to invoke Section 230. So these guys are going to be newsstands, basically, and they're not going to be able to have opinions and have protection under Article 230, which will be a big deal because right now they're having it both ways. They're totally unaccountable. They can't be held accountable for anything, and they have their finger on the scale. So that'll make it so they'll have to choose one direction or the other. There's a whole slew of things. In fact, that 6 minutes has more First Amendment protections in it than the last 20 years of presidents. It's really good, honestly. If you haven't heard it, I think Elon Musk posted it out there on X. You can find it out there. I think you'll have a hard time finding it on Google because they don't want to talk about it, but it is out there. And then he went on a little bit later to release one for the Second Amendment and talked about conceal and carry reciprocity, meaning if you have a conceal and carry license, you can go across state lines, even into states that do not recognize it, because he said your Second Amendment rights do not end where the state line begins. Mm-hmm. And I totally agree with that.
Right.
You know, the Second Amendment is very broad and should be treated as such. So it'll be interesting to see how all this happens. But I mean, basically, he's going to the Constitution, pointing at the Constitution, saying, hey, this is what makes America great. And if we're going to make America great again, this is what we have to be looking at.
Jake, we've got a lot to talk about on the show today. Taxes, deregulation, oil, banks, tariffs, you name it. So for our listeners, stay tuned for that. But I do want to take just a moment now to talk directly to our listeners. If our conversation today resonates with you, if you have some questions about how the Trump presidency is going to affect you in your journey towards a confident retirement, if you want to look to take advantage of opportunities that may present themselves, I highly encourage you to come in and sit down with us and talk to us here at Floyd Financial Group, a casual conversation one-on-one to get the answers that you need to put you on a path towards a confident retirement. Now, you can do that right now by calling 417-889-7233. I know it's Saturday, you're listening to the program today, but go ahead, make that call at 417-889-7233. Leave your name, telephone number. Ashley will call you back during the week and set up that appointment for you. Again, it's just a casual conversation. There is absolutely no cost to this. There is no obligation, and certainly there's no judgment. We'll meet you where you are. 417-889-7233. While you're at it, go out to the web. Check us out online at floydfinancialgroup.com. Time for a break, Jake. When we come back, we'll continue our conversation about Trump Presidency 2.0 when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about deregulation and why it's such a big deal.
And Jake, I'm reading a headline here which says more free markets, less harsh oversight. Donald Trump's win is about to boost banks in a big way. Can you expand on that?
Yeah, so regulation in general makes everything more difficult, costs more money, and takes more time. And so when we're thinking about deregulation as it results to these different businesses, so banks, for example, one of the big regulations on banks is that they have more and more and more reserve requirements. So after 2008, Dodd-Frank came later and basically made it so that these banks have to have huge amounts of reserves on hand all the time. The thinking is that the Fed said, hey, if these people have enough cash, maybe the reserve requirements before are $100 billion, now we got to have several $100 billion. If we just make the reserves high enough, then it can account for any problem that they might have, any financial shock that they might have. So instead of actually fixing the problems in the system, they just said, hey, just hold on to all this cash. If they're holding on to all this cash, that's money that's not working for them, not making money. And so when Trump got elected, immediately, a lot of these banks, even big banks, were up 10%, 15% the next day. And it's because of the expectation that he'll roll back regulation. If he rolls back regulation, in the bank's case, it'll be reserve requirements. If he lowers reserve requirements, he's not going to get rid of them altogether. He needs them, but we're not going to have these gigantic reserve requirements, most likely, which will turn into profit for these banks. And so where I was very concerned about banks under a Kamala presidency, I am not really concerned at all about banks under a Trump presidency. And that deregulation and the greasing of the wheels of interaction, less paperwork, less minutia, less things getting in the way of these companies making money, will turn into better profits and better, trading margins and all that. Every time they report earnings, I think we're going to see it in the numbers.
So the banking regulation, or at least the deregulation there, could be a bump for bank stocks. We're already seeing it. We'll have to see if that continues into the future. Other deregulation, Jake, what are some of the other deregulations that we could maybe look forward to?
Yeah, so anybody who's been watching Tesla's stock over the last week or 10 days since Trump got the nod here knows that Tesla shareholders believe there's going to be less regulation because the stock was up 50% in the first 4 days after Trump got in. And what that's about is the big thing with Tesla looking forward is it's not about how many cars they sell. It's not about how many cars they build and deliver like it used to be. The main thing with Tesla is, are they going to be able to solve autonomy? Are they going to be able to have this cyber cab fleet, which is basically a fleet of robo-taxis, right? So there's no driver, there's no steering wheel in the car. And these cars will basically be like Uber or like a cab, but there won't be any people, right? What's the big problem with Uber? Why does Uber struggle so much? It's because they have to pay these people. People aren't reliable. People don't do like they're supposed to do. And so if you eliminate the people, not only does your cost go down, but most likely your quality goes up, and it'll make them be able to compete in a way where nobody can touch them. And so that's the big thing to watch on Tesla right now. And so because Elon helped Trump get in, I think the market is thinking that Donald Trump will help him have less regulation when it comes to full self-driving testing and implementation. And we're starting to see that in the stock price. I mean, if they get that done, the stock price will go way, 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 way higher than it is right now. But even just the idea that this might get done has moved the stock 50% in 4 days. So that's the scoop on Tesla, and that will be the case for all companies that are wanting to do autonomous vehicles. But Tesla is probably the most robust at this point, certainly in the United States.
Let's talk about energy and energy stocks, Jake. How will deregulation affect that?
Yeah, and so listeners may be noticing a theme here that deregulation kind of affects everything, right? Mm-hmm. When it comes to oil and gas, obviously fracking is a big one. Fracking is a little bit divisive when you talk about it because some people think it's good, some people think it's bad. Most of the people that think it's bad don't even know what it is, in my experience. And so fracking done right can be very clean and not pollute the environment, and also makes the overall mining process much more efficient, meaning we don't have to have as many rigs, we don't have to have as many irons in the fire, so to speak, as my grandpa would say. We don't have to have so many rigs everywhere to get the same amount of oil, natural gas, all that type of thing. And so regulation so far under the Biden administration is just like, we go, can I drill? And he says no, and that's pretty much where it stops. And so if we start to have the deregulation of the oil and gas business where they're able to drill more unconstrained, they're able to pump oil where it needs to go to, and the permits for all these things are much easier to get, that'll make companies more profitable and really put America, honestly, in the driver's seat, because energy is a big deal, and he who controls oil and gas controls the world of energy, and he who controls that controls a lot of things globally. And again, that'll be hugely to America's benefit. Why should we let the Saudis be in control of what happens with oil prices, energy distribution across the world, when we can control it ourselves here? And I think this just goes back to the America first Trump's going to put America first. And I think that's, like him or don't like him. The good news is you don't have to like him to benefit from his policies.
Right, and I think America should be energy independent. And when I think about energy in this country, I think about oil reserves. I mean, I lived in Southern California for a long period of time. There were oil wells, things that were pumping there in the Los Angeles area. But beyond that, we have energy in Alaska, oil that is. We have it in Texas. But I think about North and South Dakota. That was a boom town that went to a bust. Did it go from boom to bust because of regulations, or do you think it's going to go back the other way?
I think some of it's regulation. Regulation also increases the cost of doing something. And so I think in the case of North and South Dakota, while I will admit that I am not an expert here, I would imagine that the cost to drill up there where there's less people and then pump that oil down to where we need it, coupled with the cost of the regulation, just simply makes it to where it doesn't make sense from a business standpoint to drill there. I think that's a lot of the case in Alaska as well. And so we need the deregulation and make things cheaper to pump that oil out of there. And I think we'll see those things come online in a way that we haven't seen them before. I mean, we have so much oil that we have access to here, and we need to be able to have that pumped out here so that we can regain control. America is the dog that wags the world's tail, and that needs to be the case again, despite the last 4 years of the Democrats trying to give that away with every breath in their body. I think we're going to have it come back.
We're talking with Jake Floyd of Floyd Financial Group. Our show is called Show Me the Money. Our telephone number, 417-889-7233. If you'd like to call, set up a time for you to come in and sit down and talk with Jake or Randy there at Floyd Financial Group. One-on-one conversation, just a casual conversation to ask the questions that you need to put you on a path towards a confident retirement. Let's talk about tariffs a little bit, Jake. I understand that President Trump is going to impose tariffs on a number of different things.
Yeah, the thing that I hear a lot is, people are saying tariffs are inflationary because it just makes American people have to pay more money. Okay. And I think these people are missing the big picture here. The big picture is the beauty of the tariff and the purpose of the tariff is to not pay the tariff, right? Mm-hmm. We use the tariff to control policy, to move it to a more pro-America way of doing business. Okay. Mm-hmm. And while there will be people that pay these tariffs, like a 200% tariff on China, for example, right? What's going to happen is, yes, there will be some of that gets paid, but most likely what will happen is most of these businesses will just simply source this from a different place, right? Either hopefully from America in a lot of cases, but even from just different countries to where we're not giving people who want to destroy us our money and the ability to do so. And I think that's a huge deal. But the purpose of the tariff is not to raise taxes. The purpose is to influence consumer behavior. And I think it will, and I think it's already affecting some of these companies. I saw an article that Steve Madden, who makes shoes and clothes and things like that, about 55% of the stuff they source comes from China, and they're already looking at moving it because they don't want to pay those tariffs. Trump hadn't been elected for 5 days, and it's already having an effect. And, we don't have any tariffs yet. We haven't put anything in place yet. And it's already affecting the way people do business. And so I think that having a more pro-America stance is a good thing. All these other countries do that. Randy likes to talk about this one because I think it does hit home here for us. Canada has a 300% tariff on dairy products that come from the U.S.
Right.
Why? So that they can protect their dairy industry up there in Canada. I guarantee you those people are not paying a 300% tariff on our milk. They're just buying it from Canada. And right. That's the whole point. And so I think when we're thinking about tariffs, yes, tariffs can be inflationary. Tariffs can be bad. However, I think tariffs done right can really influence for generations to come how things are sourced, where things come from, and really bring jobs and business and commerce back into our country.
Yeah, and when I think about even American-made cars, many of the components for these American-made cars, Jake, are actually made overseas and then brought over here. Do you think that these tariffs will have a pretty good effect on returning manufacturing to America and in the end, really just creating more American jobs?
Again, I sound like I'm just paid for by the Elon Musk Association here, but the only true American automobile in today's world is a Tesla.
Yeah, that's right.
Now he makes some in China, but those are not the ones we're buying here. These are made and assembled and everything right here in the United States. And there's no other auto manufacturer that can say that the cars that get sold here are made here. Some of them are, but there's a lot of them that are built in Mexico and parts are sourced from all over the place. So, I think that should change. John Deere, for example, when they denied it after he said it, but Trump said, hey, if you go and you change that plant and you take it out of the United States, we're going to put a 200% tariff on everything you bring in from there. Like 2 days later, they said, oh, we're not going to do that plant. And when they were asked about it, they said, oh, no, it had nothing to do with what Trump was talking about.
Yeah, right.
but I mean, it does, and I think a company like John Deere, they charge quite a premium because people perceive their brand to be American made and quality. And they get quite a bit more money for their tractors and their equipment than a competitor that's, a Japanese competitor or some of these other ones. They're 30 to 50% more money.
Right.
Why is that? Because they're American made and because they perceive higher quality. If you take that out and honestly, Donald Trump probably did them a huge favor because if they had gone down that rabbit hole, that might have been the beginning of the end for them. And so I think that pro-America policy is just getting started. And I think this country is going to look a lot different 2 to 3 years from now as a result of it in a good way. And I think we'll bring back pro-American policy, but also pro-American sentiment. I think people will be proud to be Americans again. And I think that's a huge deal.
I've said many times, nothing runs like a Deere. I've had many John Deere tractors, and I continue to buy more John Deere tractors. We're talking with Jake Floyd at Floyd Financial Group. And I want to go a little bit longer in this segment, Jake, because I had a thought about something that I want you to comment on here. And that is the fact that Donald Trump, Elon Musk, these are business people. And it occurs to me that the United States, really, many times, a great big business. Is that an advantage, having business people running government rather than politicians, so to speak?
I sure think so. A career politician like Nancy Pelosi just got elected for the 20th consecutive term.
Wow.
Let that sink in for a second. These people that have never done anything except sit in Washington and judge and tell everybody else what they can do and what they can't do when they've never actually done anything. They've never produced anything. How can these people possibly understand what needs to be done if they've never been in business? And the answer is they can't, and that's not necessarily their fault, but why do we still have these people up there that don't know anything? And there are exceptions to this, right? But the vast majority of Congress are career politicians. And so I think when it comes to running, being president and Congress and all of it really, I think it's a huge advantage to understand how business works, and the government is ultimately a large business. There's a few differences, but it's 80% a big business. And if you understand how that works, you understand how to employ people, you understand efficiency, you understand the cost of issuing too much debt and things like that, I think that's a good thing.
Well, I'm sure based on a conversation today, Jake, that a lot of people are wondering to themselves, how can I get in and sit down and talk with Jake or Randy at Floyd Financial Group, talk about the things that we talked about on our radio program today, and really get the answers to the questions that we need that will put us on a path towards a confident retirement. Well, that's called the Floyd Financial Group Retirement Review, or your financial review. We're offering it right now, no cost, no obligation. All you got to do to get yours is call 417-889-7233. Make that call this weekend. Leave your name, telephone number. Ashley will call you back during the week and set up that appointment for you. It'll only take you about 60 seconds to do that, but it could be the most important call that you'll make all year. 417-889-7233. No cost, no obligation, no judgment. We'll meet you where you are. You can also find out more about us online at floydfinancialgroup.com. Jake, time for a break. When we come back, we want to talk about a year-end checklist and later on, ETFs versus mutual funds. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. In this segment, we're going to be talking about things to do before year end, your year end checklist when it comes to your finances.
And according to my calendar, Jake, it is right about the middle of November. So if I'm correct, we've got about 6 more weeks before 2025 rings in here. So let's talk about a year-end checklist. Obviously, we don't want to wait until, the week of Christmas to talk about these things or call our financial advisor. So what are some of the things that we should be thinking about right now that we can take a proactive approach to put us in a good position to ring in 2025 on the right foot?
Yeah, so I think one obvious one, but one that always warrants talking about is your required minimum distributions. So if you are over the age of 73, you may need to take your RMD this year. There was a long time through COVID, or seemed like a long time through COVID, where it was suspended and you didn't have to take it. And so, last year we needed to take it. This year we need to take it. Further on that, if you have an inherited IRA, the IRS has changed a little bit the way it looks at inherited IRA RMDs. And so after the Secure Act in 2020, if, let's say, you inherited money from a parent and that parent passed away after January 1st, 2020, then you have to take all that money out over 10 years instead of being able to take it out over a lifetime with using the life table that shows exactly how much you have to take out. What's changed, though, this year is people took that to mean, hey, I could take nothing out, and at the very end of 10 years, I could take it all out at once. And so the IRS came out and put a note out clarifying, saying, oh, no. We expect you to take your RMD along the way and have it out over 10 years. So if you have an inherited IRA and you have not been taking any money out of it, you should look at taking an RMD out of that. If you have questions about that, that's something we can kind of help guide you through. But that's one of those little gotchas that people are not aware of always. So,
Jake, at this time of the year, do you do a year-end review with people? I mean, do you take a look at where they've been and maybe make a plan for the future? And for those people who are trying to do it themselves and they want to do a year-end review, what should they be looking at?
Yeah, so I don't do just specifically a year-end review, but we do have quarterly, semi-annual, and annual reviews. But obviously, I can't review everybody on the same day, Jeff.
No, of course not.
However, yeah, there are things to look at. One of the big things right now is with this major shift in political environment, I think it's a good idea to sit down with your financial advisor if you have one. If you don't have one, we're available for that, obviously, but have a sit down and go, okay, here's where I am, here's where I want to get to, and this new political environment is going to require different tactics and different investments to successfully navigate the next 3 to 5 years. And I think, personally, there's going to be a lot of growth to be had. It's not going to be in a straight line, though, and we need to make sure that we're investing in areas that are likely to do well under this new administration, and where we are in 2024, almost 2025, where the things that were important 4 or 5 years ago are not necessarily the things that are important today. And so having an eye toward that and really understanding what you're invested in, and if it needs to shift, what you shift it to.
Diversification, I think, is what you're talking about, Jake. When looking at my financial plan here at the end of this year, could it be an opportunity to change my diversification? And how should we be diversified?
Yeah, so when it comes to diversification, yes, that's part of it. Diversification for the sake of diversification is not necessarily what we want to do, simply meaning we don't want to just own everything, right? Because that means we own good and we own bad on purpose. What we want to do is make sure that if any one sector or subsector of the market gets hurt, that we don't have so much money in there that it cripples us. But otherwise, we want to have a strategic allocation to, what's going to benefit the most, hopefully, in our view, over the next, 3 to 5 years. So some of those things, just off the top of my head here, obviously artificial intelligence has become a big part of this, but I think it's going to become a much bigger part of everything, frankly, over the next 3 to 5 years. I think that oil services companies are going to be potentially a place that could be very good over the next 3 to 5 years. So not necessarily companies drilling for oil or selling oil or refining products, but the ones that are pumping it, the ones that give you what you need to build the oil rigs and things like that. Those types of companies could really see some upside over the next little bit. And so as we're looking at that, and especially one more thing, Jeff, just real quick on AI.
Right.
With AI, one of the big things that's changing right now is as these new chips and the new versions of these chips come out, they take increasingly exponentially more power to operate. More power, more cooling. More power, more cooling. More power, more cooling. And the limiter on what we're going to be able to do AI-wise is going to be how can we get power efficiently to these data centers. And so what they're starting to look at is building like miniature nuclear reactors to power these data centers because of the huge power draw that they have. And so I think there's also some room in uranium and some of the manufacturers of the parts that go into building these nuclear facilities could see some big upside as well.
Jake, I think you hinted at it a little bit there, but what are some of the opportunities that the Trump presidency could present to us here when we're looking at our year-end review that we might want to take advantage of in 2025, do you think?
Well, I think that we don't have to watch our back quite as hard, right? So the market as a whole, in my opinion, looks a lot more investable under Trump than it did under Biden. And part of the reason for that is we don't have to worry about everybody wanting to go to war with us all the time because they know we won't do anything about it. So if we can get the world back under control to where it's not looking to prey on the weak and we're not going to just sit there and let it happen, I think getting rid of these wars that are active and then also preventing new wars from starting by having strength in leadership, I think those are huge things. The market doesn't like uncertainty. So once we really see these wars unravel, I think that's good for another 5 or 10% in this market that we're not seeing just yet because Trump hasn't shown exactly how he's going to end these wars. There's really, it's almost everything, Jeff. I can't really point to all of it. I would just say that, the deregulation that we talked about earlier, couple that with just opportunity, pro-business policy, and pro-America policy that puts us in the driver's seat. I think all those things are going to come to pass.
Finally, I want to talk about risk tolerance, Jake. Does that change as you get older in life? And what should we be looking at in terms of risk tolerance?
Yeah, so it's important in any environment to reassess your risk tolerance, especially when we have any kind of big change, like changing of the presidency and, frankly, both houses. And so we want to make sure that if you were really conservative before this, was it because of that administration or are you just conservatively minded? And so we revisit that from time to time and say, hey, do we want to increase risk a little bit now that we have a little bit more favorable environment in Washington? Or do we want to just kind of stay where we're at? Or, there's a lot of different scenarios, but just re-examining that from time to time is a very good idea, and to make sure that we're on track and make sure that we get you to the goals that you set out to get to.
We're talking with Jake Floyd of Floyd Financial Group. We're talking about the year-end checklist. And again, I want to talk to our listeners here just a moment. If our conversation certainly makes you think to yourself, well, maybe I don't have all the answers. Maybe I'm not positioned the way that I should be. I have questions that I need answers to. You can call us here at Floyd Financial Group. 417-889-7233 is our telephone number. Make that call this weekend. Request your no cost, no obligation, no judgment Floyd Financial Group Retirement Review. Again, it's just a casual conversation. You'll have a little sit down with Randy and Jake to get the questions answered that you need to put you on a path towards a confident retirement. Again, it's not going to cost you a dime. There's absolutely no obligation and no judgment. We'll meet you where you are. Again, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, time for a break. When we come back, we'll wrap it all up. ETFs and mutual funds and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to talk about 5 reasons to choose ETFs over mutual funds in your portfolio.
And Jake, when deciding between an ETF and a mutual fund for your portfolio, there are several key factors to consider. So let's start with ETFs over mutual funds. What is the first thing that you think that people should be thinking about here?
I think the first thing to think about here is one of the first things to think about in general when it comes to your portfolio, which is cost. We need to keep the cost in your portfolio as low as we possibly can, because especially over 10 years, 20 years, 30 years, 40 years, any money that we're not paying in fees really adds up over time because of the compounding of interest on that money that you otherwise would have paid out in fees. And so the average ETF is much, much lower in expense than the average mutual fund. And part of the reason for that is most ETFs are passive in nature. They're like a package of stocks. Let's say, Randy likes to liken it to the grocery store. So, when you go to the grocery store, you have the dairy department, and you've got the meat department, you got the bread aisle. And so with ETFs, a lot of them are sector-based or subsector-based. So say, hey, I want the technology ETF or the consumer staples ETF. If we want to go even more in, the bank ETF, right? And so because they're passive in nature, a lot of times the cost is way less than the mutual fund counterpart because there's not as many people to pay, right? And so a lot of times a mutual fund might be 0.7%, while the ETF is 0.1% in some cases. But certainly they're much cheaper on average overall.
Jake, does tax efficiency enter into this conversation? Are ETFs more tax efficient than mutual funds?
Yeah, what I would say, I don't know if they're necessarily more efficient, but they're definitely you get more say in what happens to you in an ETF, because the ETF doesn't automatically pass through all the capital gains and things to you, versus a mutual fund manager can simply choose whenever he sees fit to pass through to you a huge capital gain if he wants to, or if he doesn't want to, he can kick it to the next year. So sometimes you might have a good year and sometimes you might not have a good year. And if he doubles up on your good year by also passing you through a whole bunch of taxes, that can really blow up in your face. Versus an ETF, if you simply hold it and you do not sell it, you will not have capital gains. And then you can liquidate that if and when you so choose to trigger taxes or not. Now, again, we're obviously talking about after-tax accounts at this point. So in an IRA, you don't have to worry so much about the tax efficiency because that money's all pre-tax if it's a traditional IRA. So when you buy and sell things, there's no tax consequences to that. It's only tax when it comes out.
We're talking about 5 reasons to choose ETFs over mutual funds in your portfolio. More transparency, Jake. I understand that is another advantage of the ETF.
Yeah, so with mutual funds, they're required to disclose what's being held inside there quarterly or semi-annually, depending on the fund and how it's set up. ETFs are very transparent. You can see day to day what happens inside there and what the holdings are. So that may not seem like a really big deal to the average person, but when you're building a portfolio, especially as a fund manager or as somebody who manages assets for a living, it's very important for me to know what's inside these ETFs on a day-to-day basis. What if I have 2 funds and I think I'm diversified, but both those funds simply hold the same thing? Or maybe they started not holding the same thing, and then they made changes I didn't know about, and now we're holding the same thing and we're not diversified, right? So there's so many reasons why the transparency is important, but having that transparency inside of an ETF is a big deal. Part of that too is, and this kind of goes into number 4 here, but when you trade ETFs, they trade open on the stock market, meaning you can sell them intraday. A mutual fund you can only sell at the end of the day each day. And so if you push sell at 9 a.m., you're going to get the price at the end of the day at 3 p.m. our time. Versus an ETF, if you want to sell it at 9:31 and 30 seconds, you just push sell and it'll sell it right then. And you're not subject to what happens the rest of the day. And so you're a little bit more a little bit more specific about your entry points and your exit points, which can make the difference in certain types of environments.
I think about market timing. Is that a danger? I mean, should you really do that? Be selling this, like stocks multiple times a day?
Definitely not. Definitely not. So really more what I'm referring to, Jeff, is let's say, and this happened to us. So in 2020, during the lockdown of the pandemic, right, the market was just in free fall. The market went down 35% in 20 sessions. And a lot of people don't realize the market was even down that much because by the time they got their April 1st statement, it had come back 15%. But during that free fall period, during the mid part of March, there was a day where if you would have sold at the open of the market was down 2%. But by the end of the day, it was down 13%. And so if you would have sold when it was down 2% instead of 13%, obviously that saves you a bunch of money. I am not saying that we need to be in and out and in and out and in and out. I'm simply saying that there are times where that can save you a boatload of money if you are not having to hold it till 3 p.m. that day. Again, those times are fairly few and far between, but man, it really matters a lot. And like that illustration I just gave, that was 11% on one trade. That's a big deal. And so being able to have agility if we need it, not necessarily that we do need it, right? Another example would be the election, right? So if I get in and I want to buy mutual funds the day after the election, and I buy those, I get them at the end of the day after whatever happened in the market that day. Maybe I want to get in at the beginning of the day because I think it's going to keep running during the day, and it did. And I think being able to get in at the beginning of the day so that you can participate in that day's gains is another reason. And so it's not always a big deal, but it is a big deal. And when it is a big deal, it's really a big deal for that short period of time.
Jake, are there different minimums with ETFs versus mutual funds?
Yeah, so ETFs, most ETFs, you just have to be able to buy one share at a time. There are exceptions to that, versus mutual funds have their own self-described limits. Like one of the better mutual funds to be in out there is one of the index funds that tracks the S&P 500. It charges like 1.5 basis points or 0.015% per year. So very, very low cost. The problem is you have to have $200 million to get into it. That's the minimum buy price.
Yeah.
And so with ETFs, if there's an ETF out there, you can simply just buy that ETF as long as you can afford one share of it. There are some ETFs you can trade fractional shares of, meaning less than one share. But by and large, if you can buy one share of that ETF, you're good to go.
So a lot of people may prefer an exchange-traded fund over a mutual fund because of their cost efficiency, their tax advantages, and transparency, among other things. But, Jake, are there times when a mutual fund may have its advantages over an exchange-traded fund?
Yeah, so if you do not have a financial advisor and you're going out looking for something that's actively managed, a mutual fund chassis could make sense because those guys are actively managing most of these funds. There are some hedge funds that you can get that are set up as mutual funds, right? So you have some of these superstar money managers and like Ron Barron, who famously had like 50% of the fund in Tesla stock during its huge rocket up, and he averaged like 40% a year for a certain period of time. There are some reasons to do mutual funds out there, but I will say that for the most part, a lot of those reasons are a little bit antiquated today, and the cost simply, in my opinion, does not outweigh the benefit of going ETFs versus mutual funds. The cost is probably the big one. I know that's the one we talked about first, but really keeping cost as low as we possibly can inside the portfolio is a really big deal. And if you're hiring somebody to actually manage your money, then you want them to also keep the additional cost to the bare minimum. And so that's our goal here. We want to keep costs low and investment performance high if we can. You know, that kind of depends on the environment, but I do think we're likely heading into a period where there's going to be a lot of growth to be had. And if that potential growth does come through, we want to make sure we keep as much of it as possible and we're not paying it out in fees.
Jake, there's another national talk show host who often talks about putting money into a good growth mutual fund. He primarily specializes in helping people get out of debt. But if you are looking at the difference between an ETF and a mutual fund, what should you really be looking at to make that decision for you personally?
Yeah, so there are, last time I looked, roughly 60,000 mutual funds. There's a ridiculous amount of these mutual funds out there. There's not nearly so many ETFs. There are thousands of ETFs, but not that many. When you're looking at a mutual fund or an ETF, most of them have kind of a goal purpose, right? So an index fund tracks an index, or a sector fund tracks that sector. Or if you're in mutual funds, and your goal is to get into one of the hedge fund mutual funds, then your goal is to try to do well in any type of environment, right? You want to go up when the market's down, and you want to go up when the market's up, but you're going to forfeit some of that gain. And so understanding the purpose of your money is step one. Like, what do you want to have happen with this money? Is it retirement money? Is this money that you want to pass on to a beneficiary? Is this money you want to donate to charity? Is this money you want to use to help your kid buy a house? There's a million different purposes for money, and determining that purpose will answer most of the questions about what direction you want to go with your investments and what strategy is right for you depending on those goals. And that's really where a financial advisor can come in and say, hey, show me your goals, and I can show you the top 2 or 3 strategies that you should probably be looking at to help accomplish those goals.
So we're going to plan with the end in mind, and we're going to reverse engineer based on what your goals are. Talking with Jake Floyd of Floyd Financial Group. Jake, we've had a great conversation today. I know a lot of people may not have heard the first part of the program. If that is you, we're also a podcast. Go to wherever you get your podcast. Search for Show Me the Money with Randy and Jake Floyd. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. And before we go again today, Jake, I want to remind listeners, 417-889-7233 is our telephone number. If you would like to get in and sit down with Jake and Randy at Floyd Financial Group, ask your individual questions about anything that relates to your journey towards a confident retirement, you can call that number this weekend. Leave your name and telephone number. Ashley will call you back during the week and set up that appointment. No cost, no obligation, no judgment. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, out of time for this week. I want to thank you so much for your time, but most importantly, I want to thank the greatest listeners in the world, ours, here in the greater Springfield area. So for Jake Floyd, I'm Jeff Shade. Have yourself a great weekend. Be sure to join us again next week right here for another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.